Have you ever stopped to think that token you're buying and selling on your exchange app might be legally identical to a stock? If that's true, then the exchange you're using might not be licensed to let you trade it. The project behind it might be running an illegal securities offering, and your ability to freely buy and sell could be taken away at any moment. This isn't hypothetical. In December 2020, the SEC formally sued Ripple Labs and two of its top executives. The core allegation was straightforward. The XRP you've been selling since 2013 isn't a cryptocurrency. It's an unregistered security. Over $1.3 billion worth. The problem was, XRP had already been trading on exchanges worldwide for 7 years. Daily volume ran into the billions. Buyers and sellers didn't even know each other. That put a much more fundamental question on the table. Is a token itself a security? Or does it only become one under certain transaction structures? If the SEC was right, then almost every crypto asset could be reclassified as a security at any time. 3 years later, in July 2023, federal judge Analisa Torres handed down a landmark ruling. Same token. Two different legal outcomes. XRP sold by Ripple to institutional investors constituted a security. XRP traded by retail investors on secondary markets did not. One token, two legal destinies. That ruling wasn't just about Ripple. It cracked something open, and it forced the entire industry to ask, where exactly does securities law end? In the age of crypto? Welcome to the Digital Asset Policy Lab. Markets move every day, but the rules are always there. 2025 to 2026 is shaping up to be a critical window. For traditional institutions entering the crypto space, BlackRock, Fidelity, and other giants are already building out Bitcoin spot ETFs and tokenized funds. Goldman Sachs and JP Morgan are accelerating their digital asset infrastructure. But before institutions can move in, they need to answer one fundamental question. What law governs what I'm buying? So today, we're going to do a deep dive into a key document, the SEC's latest interpretive guidance on crypto assets, published in March 2026. Why does this deserve your full attention? Because this is the first time in over a decade that the SEC has systematically, directly told the market, here's how we think about crypto assets, and here's how we make our determinations. For the past 10 years, the SEC's approach was essentially to regulate by enforcement. Let things happen, then sue when something went wrong. That's not a metaphor. It's what the industry literally called it. Regulation by enforcement. The SEC has brought over 500 enforcement actions in total, with well over 100 targeting the crypto industry specifically. From the 2017 DAO report to the Ripple lawsuit to suing both Binance and Coinbase in 2023, the SEC went after virtually every major player in the space. That's why the industry gave the SEC a nickname, the Securities and Everything Commission. That was a dig at former chair Gary Gensler, who repeatedly insisted that almost all crypto assets, Bitcoin aside, should be registered as securities. That position made the entire industry furious. Exchanges didn't know which tokens they could list. Projects didn't know whether they needed to register. Two tokens built on identical technology could get completely different treatment, with no clear explanation why. Nobody could tell you what the standard actually was. This new guidance is designed to fix that. It draws a line. And once that line exists, companies know how to comply. Investors know what protections they have, and institutions can actually commit capital. The core philosophy of the document comes down to one sentence. The legal nature of a crypto asset is determined by its economic substance, not by what it's called. A token is just a token. Some are payment tools, some are governance instruments, some are, in substance, investment interests. You can't look at a bunch of things running on a blockchain and say they're all securities, or none of them are. So how does the SEC actually categorize them? The document breaks crypto assets into 5 categories: digital commodities, digital collectibles, digital tools, stablecoins, and digital securities. The guidance is explicit. The first 4 categories are not securities. Only the 5th, digital securities, falls under securities law. How does the SEC justify that distinction? The answer lives in 2 foundational statutes, the Securities Act of 1933 and the Securities Exchange Act of 1934. These laws define securities through enumeration: stocks, bonds, notes, traditional instruments with clear structures, easy to identify. Crypto assets are different. Take ETH. It's the gas that powers the Ethereum network. It can be staked for yield. It's used as collateral in DeFi protocols. Is it a stock? No. A bond? No. It doesn't fit neatly into any traditional securities category, but securities law has a catch-all provision: the investment contract. The investment contract concept exists for instruments that are too varied or complex to categorize directly. If something qualifies as an investment contract, it's still subject to securities regulation. Think of it as a universal adapter. Congress probably didn't anticipate crypto, but they left an opening to capture any arrangement that is, in substance, an investment. So how do you determine whether something is an investment contract? That's where the most famous test in U.S. securities law comes in: the Howey test. It comes from the 1946 Supreme Court case, SEC versus W.J. Howey Company, which was actually about orange grove plots in Florida. But the standard it established is still the SEC's primary tool for evaluating crypto assets today. The Howey test has 4 elements, and all 4 must be satisfied. First, there's an investment of money. Second, that money goes into a common enterprise. Third, the investor has a reasonable expectation of profit. Fourth, and this is the critical one, that profit expectation depends primarily on the entrepreneurial or managerial efforts of others. Hold on to that 4th element. We're going to come back to it repeatedly. Let me translate this into plain English. If a project takes your money and promises to use their technology, operations, and management to generate returns for you, that arrangement is an investment contract. That's a security. Full stop. Now, let's apply the Howey test to each of the SEC's 5 categories. Category 1, digital commodities. This primarily covers native tokens of blockchain networks: Bitcoin, Ethereum. The SEC's position is that their value derives from the programmatic operation of a decentralized network and market supply and demand. There's no central party whose managerial efforts you're depending on. Bitcoin has no CEO. Vitalik Buterin has influence. But the Ethereum network doesn't depend on his day-to-day management decisions. So, not a security. By the way, back in 2018, then SEC Director of Corporation Finance, William Hinman, gave a speech strongly suggesting Ethereum wasn't a security. This guidance effectively makes that position official. Category 2, digital collectibles. Primarily NFTs. Value is based on artistic merit, cultural significance, and market supply and demand, not on anyone's entrepreneurial efforts. Whether a crypto punk appreciates has little to do with what Larva Labs is doing right now. Not a security. Category 3, digital tools. Think ENS domain names, Filecoin storage credits. Buyers are acquiring functional access to a service, not making an investment for profit. The profit expectation element isn't satisfied. Not a security. Category 4, stablecoins. Important distinction here. Under the Genius Act currently moving through Congress, payment stablecoins, USDC, USDT, dollar-pegged instruments used for payments and settlement, are explicitly excluded from the definition of a security. But if a stablecoin comes with a yield distribution mechanism, Say, it promises holders a share of interest earned on reserve assets. Then it could trigger the Howey test and potentially be classified as a security. Category 5. Digital securities. These are traditional securities in digital form. Tokenized stocks, tokenized bonds, tokenized fund shares. The underlying nature hasn't changed, only the wrapper has. Securities law still applies. If you look across all 5 categories, a pattern emerges. The Howey test is really asking one question. Is there a centralized operator in the background, generating returns on your behalf? Yes, it's a security. No, it's not. In other words, the Howey test is essentially a centralization detector. It requires a concentrated project operator, a pool of investors handing over capital, and an explicit promise of returns. The SEC's logic is simple. If something goes wrong, I need to be able to find someone to hold accountable. You can't sue a decentralized smart contract. But here's a critical nuance that a lot of people miss, and it's actually the most important part of this document. You might be thinking, fine, I'll just stick to non-security tokens. Bitcoin, Ethereum, Dogecoin, all digital commodities, all safe. Not so fast. The SEC is clear. A token not being a security doesn't mean it can never be part of a securities transaction. Here's an example. Bitcoin is unquestionably a digital commodity. Buying and selling Bitcoin on an exchange is not a securities transaction. But if someone creates a Bitcoin investment fund, pools Bitcoin into a vehicle, sells shares in that vehicle, and promises to actively manage it to generate returns, every element of the Howey test is now satisfied. There's an investment of money, a common enterprise, a profit expectation, and reliance on someone else's management efforts. The Bitcoin hasn't changed, but the transaction structure has. And that changes the legal characterization entirely. This isn't theoretical. In 2024, the SEC brought enforcement actions against multiple unregistered crypto lending and yield products, including Genesis and Gemini's Earn program. The legal logic was exactly the same. Now, go back to the Ripple case, and everything clicks. Under the SEC's framework, XRP itself is treated as a digital commodity. But Ripple's targeted sales of XRP to institutional investors, VCS hedge funds, from 2013 to 2020, constituted investment contracts. Why? Because those institutions bought XRP specifically. Because they expected Ripple's team to keep developing, promoting, and increasing XRP's value. Classic reliance on the entrepreneurial efforts of others. What about retail investors buying XRP on secondary markets? They didn't know who they were transacting with. They weren't making investment decisions based on Ripple's promises. So the court found those transactions didn't satisfy the Howey test. Same token. Different sales structure. Different legal outcome. That's the most important line in this entire document. The legal nature of a crypto asset doesn't depend on the technology. It depends on how you sell it. An investment contract isn't a permanent label stamped on a token. It has to be traced to a specific transaction structure and economic arrangement. This is what the SEC means when it says, look at economic substance, not surface labels. So here's the uncomfortable truth. Price volatility gets all the attention, but it's legal classification that's actually less stable. Now, just when you think you've got a handle on this, the SEC throws in something even more counterintuitive. A token that's classified as a security at one point in time doesn't have to stay a security forever. Wait, a security can stop being a security? Yes. The guidance introduces what I'd call a separation doctrine. The idea is that security status is not permanent. It can expire. A token can, in effect, graduate out of securities classification. The same token can be a security in its ICO phase and a digital commodity later on. Same token, different legal status at different stages. That sounds contradictory, but it's actually the key to understanding the entire regulatory framework. The SEC identifies two scenarios in which a crypto asset can separate from investment contract status. First, the issuer has completed the essential managerial efforts it originally promised. Concretely, the network has become sufficiently decentralized. There's no longer any single project team or core developer who exercises controlling influence over the ecosystem. Routine maintenance can continue, but the core control has been genuinely dispersed. This logic maps directly onto the Ethereum narrative. Hinman's 2018 speech, even though it was personal commentary, not official SEC policy, argued that Ethereum had become sufficiently decentralized, that current ETH sales didn't constitute securities transactions. That reasoning is the direct ancestor of the separation doctrine in this guidance. Second, the issuer has explicitly abandoned its prior commitments and is no longer responsible for investor returns. Basically, investors can no longer realistically count on this team to turn things around. So, ironically, if a project collapses, it might actually shed its securities classification in the process. That's a dark joke. But the legal logic holds. Both pathways come down to the same question. Do the efforts of others still exist? Once separation is complete, the asset reverts to its intrinsic nature. It might be a commodity. It might be a utility token. But it's no longer subject to securities law. This framework resolves a question that has plagued the industry for years. What is the legal status of a given token at different stages of its life cycle? Early on, when the team is driving everything, it's a security. Once the network matures and decentralizes, it can become a commodity. The SEC's regulatory paradigm has shifted. It's moved from asking, "Is this token a security?" to asking, "Does this transaction, in this structure, constitute a securities offering?" The SEC isn't regulating code. It's not regulating tokens, it's regulating relationships. The relationship of promises and expectations between a project and its investors. The Ripple ruling illustrated this perfectly. Judge Torres found that XRP itself wasn't a security. But Ripple's institutional sales were unregistered securities offerings, while programmatic secondary market sales were not. Same token, different contexts, different legal outcomes, entirely consistent with the separation doctrine we've been discussing. We've covered the Howey test. Now let's get practical. What does this classification framework actually mean? For different market participants? Start with project teams. For a project, the difference between security and not a security isn't an academic question. It's existential. One path leads to a lightly regulated technology product, the other leads to a heavily regulated financial product. The compliance cost difference isn't marginal. It's an order of magnitude. If your token is classified as a security, you have to register with the SEC, fulfill ongoing disclosure obligations, comply with anti-fraud requirements, and submit to continuous oversight. You can pursue exemptions. Regulation D for private placements to accredited investors. Regulation A for smaller public offerings. Regulation S for offshore issuances. But even exemption paths carry significant compliance burdens. What does full registration actually cost? Registration plus ongoing disclosure can run several million to over $10 million at the issuance stage, with annual compliance costs in the hundreds of thousands to millions of dollars thereafter. If your asset clearly falls outside securities classification, costs drop dramatically. You might need a legal opinion letter demonstrating you don't satisfy the Howey elements, plus basic KHEC and AML compliance. Total cost somewhere between $50,000 and $200,000. Ongoing disclosure costs? Zero. The gap is equally stark in secondary markets. Non-security assets can list on exchanges through a relatively straightforward commercial process. Security tokens require integration with an entire traditional financial infrastructure stack. broker-dealers, registered exchanges or ATSs, clearing facilities, qualified custodians. Every layer requires a license, costs money, and takes time. Listing and annual compliance can easily exceed $1 million, and investor eligibility restrictions significantly reduce liquidity. Now let's talk about exchanges. For exchanges, securities classification has never been just a label. It implies an entirely different business model. A non-securities exchange is fundamentally a technology platform. A securities exchange is fundamentally a financial infrastructure operator. The operating costs, listing timelines, and liquidity profiles are in completely different leagues. Take Coinbase. Its core business is non-security crypto asset trading. It holds money transmission licenses across nearly every U.S. state. Think of these as payment and remittance type licenses. Total licensing costs are relatively modest. Annual compliance runs in the low millions. Tokens can be listed in a matter of weeks, and the platform can access global retail liquidity. Now, what if you wanted to operate a securities exchange under the SEC's framework? The licensing costs alone would run anywhere from $5 million to $50 million, or more. Annual compliance costs? Another $5 to $20 million on top of that. Getting a single token listed takes anywhere from 6 to 18 months. And your customer base would be dominated by accredited investors. Retail participation would be severely restricted. Here's a perfect illustration of that tension. In 2023, the SEC sued Coinbase, alleging that it had been operating an unregistered securities exchange. That case still hasn't been fully resolved. But it makes one thing crystal clear. How you're classified determines what regulatory regime you're operating under. Full stop. So let's put it simply. For a crypto exchange, switching from a non-securities model to a securities model means costs go up tenfold, timelines go up tenfold, and you lose more than 90% of your liquidity. And if former SEC Chair Gary Gensler's vision had played out, where nearly every token is treated as a security, traditional giants like the NYSE and NASDAQ would have had an overwhelming structural advantage. Most crypto-native exchanges simply wouldn't have survived. Now, let's talk about what this means for everyday retail investors. The short version: less risk, but fewer opportunities. If a crypto asset gets classified as a security, the SEC can invoke investor suitability rules to block retail investors from participating in primary market offerings. Want in on an early funding round? You'd need to qualify as an accredited investor. That means annual income above $200,000 or net worth above $1 million, excluding your primary residence. Most retail investors don't meet that bar. They're locked out from the start. But there's a flip side. Securities law requires mandatory, periodic disclosures, and that actually gives secondary market participants something to work with. You'd know the project's financials, related party transactions, and material risk factors. It's no longer a complete information black box. For institutional investors, though, the dynamic is completely reversed. Securities classification isn't a restriction. It's an entry ticket. Why? Because large funds, pension funds, insurance companies, they all operate under strict investment mandates. Their compliance frameworks often only allow them to hold assets that are formally classified as securities. Non-securities crypto assets can't be held. They can't go on the balance sheet. And they carry uncertain capital treatment. Under the Basel Committee's framework, unclassified crypto assets can carry a risk weight as high as 1,250%. But once a crypto asset is classified as a security, institutions suddenly have a clear path. Custody has a compliance structure. Valuation has a disclosure basis. Risk management has a defined framework. So here's what's really happening. Securities classification looks like a legal label on the surface, but underneath, it's a filtering and reshuffling of the investor base. Retail gets pushed towards secondary markets. Institutions get invited into primary markets. The capital structure shifts, the pricing logic shifts, and the entire market ecosystem gets reorganized. This isn't just a regulatory label. It's a fundamental restructuring of market architecture. Now, some of you are probably wondering about CARF, the Crypto Asset Reporting Framework, the global tax reporting standard that's been gaining momentum. Will it affect how you file taxes? Does it interact with the SEC's securities classification? I'll tease this for now, because it deserves its own dedicated episode. Here's the key insight. The asset classification used for securities regulation and the one used for tax purposes are entirely separate frameworks. ETH, for example, might not be a security in the SEC's eyes, but in the IRS's view, it's property subject to capital gains tax. These two systems operate independently, so the short answer is they don't really interact. Don't worry about that overlap, but we'll dig into CARF properly in a future episode. Stay tuned. All right, now we get to the question that actually keeps people up at night. Forget the theory. Just tell me, is what I'm doing right now considered securities trading? Am I already breaking the law? Take a breath. Because the SEC has actually given some pretty clear answers here, and honestly, the answers are more favorable than a lot of people expected. Let's start with mining and staking. Both are in the clear. That's right. Proof-of-work mining and proof-of-stake staking are not classified as securities issuance. That's probably one of the most reassuring conclusions in the entire document. But here's where sharp thinkers will push back. If you're delegating your ETH to a node operator or pooling your hash rate with others, you're putting in capital. You're depending on someone else to run the infrastructure, and you're expecting a return. Doesn't that sound exactly like what the Howey test describes? Expectation of profits from the efforts of others. Great question. And the SEC actually draws a really important distinction here. The efforts of others in the Howey test isn't just anyone doing anything. The original language says those efforts must be, quote, undeniably significant. And specifically, they must constitute entrepreneurial effort. That means the kind of active management decisions that actually determine whether a project succeeds or fails, and whether investors make money. Staking and mining don't fit that description. In the SEC's view, these activities are fundamentally about the automatic execution of network protocols. When you stake 32 ETH and become a validator, your rewards come from Ethereum's protocol-level distribution mechanism, not from some issuer sitting in an office deciding how much to pay you. You're participating in a permissionless, open network. You're not investing in a centralized team's business plan. The SEC actually uses a specific phrase for this kind of activity: administrative and ministerial activities. In plain English, you're doing the legwork, not running the business. And because of that, the core requirements of the Howey test aren't met. It's not a security. This distinction is critical. It draws a clear line. Are you participating in infrastructure operations, or are you participating in an investment scheme? The former is not a security. The latter is. Keep that line in mind. We'll come back to it. Next up, cross-chain bridges and wrapped assets, like converting BTC into WBTC. The SEC's logic here is straightforward. Look through to the underlying asset. If the original asset isn't a security, Bitcoin, for example, then its wrapped version, WBTC, isn't a security either. Wrapping is a technical cross-chain mapping. It doesn't change the legal character of the asset. Conversely, if the original asset is a security, wrapping it doesn't change that. You can't use a technical wrapper to escape regulatory scrutiny. That's intuitive enough. But here's the nuance that's easy to miss. If a wrapped asset is designed with additional yield mechanisms on top, automatic compounding, yield optimization strategies, and develops its own independent return profile, then you can't simply look through to the underlying asset anymore. At that point, it needs to be evaluated as a standalone derivative product, And that is where securities classification could be triggered. The same logic applies to liquid staking tokens. You stake ETH and receive STETH. If STETH is purely a receipt representing your locked ETH, nothing more, it won't independently be classified as a security. But if the token itself is designed as an investment product, with its own yield distribution mechanism and active management behind it, that's a different story. The SEC's approach is consistent throughout. It doesn't care about the name or the technical form. It looks at the economic substance. Now, let's talk about airdrops. The conclusion here is fairly clean. If users don't provide any consideration, no money paid, no meaningful service rendered, then an airdrop doesn't constitute a securities offering or distribution. That's because the very first prong of the Howey test, an investment of money, isn't satisfied. But pay attention to the edge cases. If an airdrop requires you to complete specific tasks, that constitute genuine substantive consideration, and there's a clear link between that consideration and the tokens received, then it could be treated as a securities offering. So those airdrops that require you to lock up significant assets for extended periods, they may not be as free as they appear. Now let's look at the compliance pathways for intermediaries, staking service providers, liquid staking protocols, and wrapped token issuers. This is one of the most practically useful parts of the document. The SEC essentially draws a clear compliance boundary. Are you providing infrastructure services, or are you managing assets? If you're a staking service provider, you don't promise yields, don't guarantee returns, don't make investment decisions on behalf of clients, don't engage in restaking, and don't pool client assets for active management. In other words, you're a pure technical conduit. Then you're performing administrative functions. No securities regulation triggered, but if you start promising APY, actively optimizing yields, deploying DeFi restaking strategies, and effectively making investment decisions on behalf of your users, then you're in the business of asset management, and that requires registration and compliance under securities law. Once that line is clear, it actually opens up significant room for innovation. You can envision a new generation of compliant staking infrastructure, non-custodial, user-controlled, with service providers offering only technical interfaces and node operations. Think of it as the AWS of blockchain. You don't own the client's data. You just provide compute. Same logic here. You don't own the client's assets. You just provide the staking channel. The SEC's regulatory logic for this entire category, in one sentence, distinguish infrastructure activity from asset management activity. The former gets a pass, the latter gets regulated. Let's zoom out and look at what this framework actually means at a higher level. The most important thing this framework does is not simply stamp assets as securities or not securities. It establishes a dynamic classification system, one that respects the technical realities of how these networks actually work. It acknowledges that genuine decentralization has real legal significance. A truly decentralized network shouldn't be regulated, as if it were a centralized issuer's investment scheme. At the same time, it protects investors during the early stages of a project, before decentralization has actually been achieved. For the industry, this means the compliance path is finally visible. If you follow the rules, complete the decentralization process, or clearly define your business boundaries, you can move beyond securities regulation. In the past, everyone was guessing what the SEC might do, whether an enforcement action might drop at any moment. Now there are defined rules. Innovation can happen within a clear framework. Yes, there will be adjustments. Some issuers will need to revisit their business models, particularly around asset classification and investment contract management. But that's a one-time correction. The long-term benefits far outweigh the short-term pain. The core value of this framework comes down to one thing: returning certainty to the market. Certainty is the precondition for capital formation, for innovation, and for the United States to genuinely become the global hub for digital assets. Many projects chose to launch offshore, precisely because U.S. regulatory risk was too unpredictable. Now that the rules are clearer, there's a real incentive to come back. Regulatory clarity could become a powerful force, pulling offshore activity back onshore. That said, we have to be honest about what's still unresolved. This document provides important guidance, but it also leaves several significant questions open. And those open questions may well be the flashpoints for the next round of regulatory disputes. First, mixed characteristic assets. Real-world crypto assets are rarely black and white. Many tokens combine payment functionality, investment characteristics, and governance rights. Take a DAO governance token. Holders can vote on protocol parameters, but they also share in protocol fee revenue. Is that a governance tool or an investment contract? The SEC mentions looking at the dominant characteristic of an asset, but that concept is inherently subjective. When multiple functions are roughly equal in weight, who decides which one dominates? Whether the four-prong Howey test can cleanly handle these complex scenarios is, frankly, still a big open question. Second, measuring decentralization. Decentralization is a key variable in the SEC's framework. The more decentralized a network, the more likely it falls outside securities regulation. But what exactly counts as truly decentralized? How do you measure it? Is it about open source code? Distribution of governance power? Whether the founding team still has meaningful control? Node count? I'd go further and raise a deeper question. Can decentralization even be quantified? We need to be careful not to conflate two concepts that often get mixed up. Distributed and decentralized. Distributed is a technical architecture concept, and it is measurable. How many servers? How many geographic locations? What consensus mechanism? But decentralization is fundamentally a governance concept. It's about how dispersed control over the system actually is. You can say a network has over 1,000 nodes and is therefore distributed. But does that make it decentralized? What if all 1,000 nodes are controlled by the same family-owned enterprise? Node count and actual dispersion of control are two very different things. The SEC hasn't provided clear quantitative standards here. That makes it very hard for market participants to form reliable compliance expectations. And if this isn't resolved, the decentralization exemption risks becoming a gray zone, where everyone claims to qualify and no one actually knows. Third, fractionalized NFTs. A single NFT, say, a piece of digital art, may not be a security, but when it's split into hundreds or thousands of fractional shares, available for broad trading, the analysis changes entirely. The issue isn't the degree of fractionalization. It's not about whether you split it into 10 pieces versus 100. The issue is the economic substance after fractionalization. Are the buyers making an investment? Are they expecting returns from someone else's efforts? If yes, the Howey test requirements may well be satisfied, and securities regulation kicks in. But the specific standards and trigger conditions aren't spelled out clearly in this document. This remains a gray area. Fourth, international regulatory coordination. Crypto assets are inherently global. A token can be traded anywhere in the world, but regulatory frameworks vary enormously across jurisdictions. The EU has MiCA, a unified classification and licensing system. The UK has its FCA framework. Switzerland has FINMA's token classification guidelines. Singapore and Hong Kong each have their own licensing regimes. None of these align neatly with the US approach. Building effective international coordination mechanisms, preventing regulatory arbitrage, and reducing cross-border compliance costs. These are challenges the entire industry faces. And right now, we're nowhere close to a satisfying answer. Finally, I want to step back and ask a more fundamental question. Doesn't it strike you as a bit surreal that we're using a 1946 court case to adjudicate the most cutting-edge digital assets of 2025? It's a bit like applying horse and buggy traffic regulations to self-driving cars. The Howey test, nearly 80 years old, is still the SEC's primary tool for determining whether a crypto asset is a security. And that fact alone reflects a kind of structural rigidity in the U.S. regulatory system when confronted with crypto innovation. It's not that Howey is completely useless, it's that measuring a new world with an old ruler will eventually produce absurd results. Look at the track record. The SEC deployed the Howey test against Ripple, Coinbase, Terraform Labs, Binance, essentially going after the entire top tier of the industry. And what happened? In the Ripple case, the judge ruled that secondary market sales of XRP did not constitute investment contracts. The Coinbase case is still dragging on. Terraform Labs ended in a settlement. Each case left the market more confused, not less. What does that tell us? Even the courts don't have consensus on how Howey applies to crypto. And the problem isn't limited to the SEC. The CFTC's role in regulating commodity-type crypto assets still isn't clearly defined. Bitcoin, the CFTC says it's a commodity. Ethereum, a former CFTC chair called it a commodity. Former SEC Chair Gensler suggested it might be a security. Two federal regulators, one asset, two different legal characterizations. What are market participants supposed to do with that? The coordination between these two agencies, charitably described, is still a work in progress. Less charitably, it hasn't really happened yet. But here's a signal that a lot of people are overlooking. Congress is actually moving. Whether you look at the FYT21 Act or the ongoing legislative debates around stablecoins, they're all pointing in the same direction. The U.S. can't keep relying on the SEC and CFTC to each make up the rules as they go. The country needs a dedicated regulatory framework, one built specifically for digital assets. In other words, the Howey test is most likely just a stopgap, a temporary fix, not a permanent answer. And look at what other major markets are already doing. The EU's MiCA framework is live and operational. It gives crypto assets clear classifications and a proper licensing regime. Switzerland's FINMA issued ICO guidance years ago, sorting tokens into three categories: payment tokens, utility tokens, and asset tokens. The UK's FCA is steadily building out its own crypto regulatory structure. The common thread across all of these jurisdictions? Rather than forcing new assets into old legal frameworks, they chose to legislate specifically for this asset class. On this front, the U.S. is actually the one falling behind. All right, let's zoom out and bring today's theme together. We've been talking about the SEC's latest interpretive guidance, specifically how it classifies different types of crypto assets. But if you treat this as just a technical classification document, you're underselling what it actually means. The real stakes in this regulatory battle aren't about defining tokens. They're about redefining what an investment relationship even looks like. Think about the foundational logic of the Howey test. It was born in a fully centralized world, a world where investors hand money to a centralized operator and expect that operator's efforts to generate returns. That's the classic investment contract structure. What this SEC guidance actually does is draw a critical line. If a project still depends heavily on a centralized team to drive its value, it will almost certainly be treated as a security. That's exactly why so many early-stage team-driven token projects carry enormous legal risk under the SEC's current framework. But flip that around. If a project has genuinely achieved decentralization, if the network runs without relying on any single team's ongoing efforts, then it may fall entirely outside the reach of securities law. This is the core reasoning behind why many legal scholars have long argued that Ethereum likely does not qualify as a security, because the Ethereum network no longer depends on Vitalik Buterin or the Ethereum Foundation to keep it running. So, what this document is really answering goes much deeper than, is this token a security? The real question it's grappling with is this. In a decentralized world, does the traditional investor-operator relationship still exist? And if it doesn't, does the foundational premise of securities law still hold? That's the real dividing line here, not a technical one, a historical one. The centralized past and the decentralized future operate by different rules, and right now, we're standing exactly on that line. Thanks for watching. Follow the Digital Asset Policy Lab. Markets move every day, but the rules are always evolving. See you next time.